All right. We're going to carry on our discussion, and like to make sure that the momentum that was built in the first session carries on. So my colleague Steve Greska has been chomping at the bits to ask a question, so I'm going to let him ask a question.
I was hoping I could keep the momentum going. And that's when we first started this morning, and you talked about the 95% commitment by the dealers, and I know there's correspondences out of that, and I've been to a couple other dealers, and they've mentioned that they fulfill this 95% commitment. They've already fulfilled it, or they continue to fulfill it. And I just, when you look at the public information, that trade information warehouse, and you see the gross and net notional and the indexes, and then you see the notional value of what's actually being cleared, I was wondering, what exactly is the commitment specific? What is the commitment, and how is it being met?
Okay, so let me clarify, because there are unfortunately a couple of 95% that actually coincide. They're not the same 95%. So first, starting with the commitment. The commitment that the G14 dealers and several large buy-side firms have made to the Global Supervisors Group was to submit 95% of new trades for clearing, okay, and afterwards so this is what we can do individually, submit the trades for clearing. Obviously, there has to be an eligible counterparty that actually on the other side of the trade. And then there was a collective commitment for what actually is going to be cleared. And we had started at 75%, and then we went to 80%.
Yeah, I think that's
They went to 80%, okay? So that was what has to be cleared cumulatively, 80% of a certain, let's say, looking at a certain index, okay? If you look at what we have actually done, we have managed to clear cumulatively or compress, which is the same thing, more than 95% of those indices. Okay, so we have exceeded that 80% commit to clear, and we have cleared more than 95% of those trades. Now, just to explain also, when you look at the numbers, sorry.
No, I was just going to say maybe go through the compression point.
Yeah, exactly. No, that's what I was getting to. When you look at the numbers currently in the warehouse, it's very difficult to actually look at them and just get a good idea as to how much has already been cleared. The reason for that is that there is an inherent compression that takes place as a result of clearing. We look at, on average, something like a 9-to-1 compression, and I'll tell you why I use the number because it's a very convenient number. So let's say we start with 11 trillion of an instrument, okay? For argument's sake, we submit 90%, or we clear 90% of those. So 1 trillion stays out, and 10 trillion is submitted for clearing and gets cleared. Out of that, it gets compressed down to something like 1 trillion. So if you look now what is cleared versus what is not cleared, you will see 1.1 trillion on one side, 1 trillion on the other side. So it will look like as if the market now, 50% of it is in the cleared state, 50% is not. But the reality is you have actually cleared 90% of what was available to be cleared. Okay? So I know the numbers get a little bit confusing in that respect, but so collectively among eligible counterparties, yes, in all these indexes that we started, we have cumulatively cleared or compressed more than 95% of them. And the numbers vary, and you will see kind of a drop in these numbers, obviously, every time we issue a new index. Obviously, it's a new instrument again. We have to restart clearing it. Also, you see the numbers drop for a short period if we add a new clearing member because more trades become available to be cleared.
And that's going all the way back to, like, say, Series 9 in the investment grade, when we see
Yes.
that notional, that 1.5 trillion notional.
Yeah, it's funny you mentioned Series 9 is one of the more,
Yes,
it's one of the
right.
few indices, actually, all the indices that kind of trades. It just happened to have a lot of names that were relevant in a lot of existing trades. That's why it maintained some liquidity. But obviously, you'll see a lot of the others, some of the indices before don't have the same activity, obviously. Sorry, Tom,
And you see that, no, I was just going to say, you can see some of the impact of this if you look at the notional outstanding in the warehouse, right? And it used to be, I'm not sure what the peak was, Mike, it was 60, 65 or something. And that's dropped down now. Today it's 25.
26, yeah.
And much of that, some of that, a little bit of that is rolling off, but a lot of that was just due to the compression that took place either through direct tear-ups or through the clearing.
If I could follow up on a point before the break that was being made, people were talking about the processing of these instruments upon a credit event and the benefits, clearing benefits of having that done in an orderly way and based on an understood set of criteria. Would that suggest, therefore, that for a particular product, the greatest market benefits come about if that product is traded through a single clearinghouse as opposed to multiple clearinghouses where there might be different sorts of criteria applied, or it might not be so well understood? And do people think that that would tend to happen as a just as a natural migration from the market demand? Would all go to a single place? Could there be a single product traded through more than one house, and would that pose complications?
I think what it points out is that clearinghouses need to be in a position to create certain elements of their services in ways that don't create a basis risk between the current market conventions and the way that the cleared transactions work. So I don't think it calls for a particular product to be cleared in a single clearinghouse, but I do think it calls for the credit event processes, for example, to be consistent to a large extent across different venues so that there is not basis risk created.
Yeah, I think that's the role we play, the trade information warehouse plays, is in the post-trade events, credit events or whatnot. By having it done one place, there is, as you said, no gap risk, there's no differences in how it's going to be handled. It's all done uniformly. So that those type of issues disappear because we are able to aggregate all the positions. So there's two benefits, in essence, in terms of what the trade information warehouse does. One is the reporting benefit of having one aggregated view, and the other one is the standardized processing of the asset servicing side of the life, and that's the role we play in the position we do. So it allows the proliferation, if you wish, or you want to have the competition at the CCP level. It permits that to happen without the operational risk of downstream processing happening after the fact, or the gap, or the arbitrage, whatever that could happen if you have different processing occurring. So that's the true benefit and the stability and the foundation. We've handled 48 credit events, I believe. I mean, when I was at Morgan Stanley, the first credit event was, I'm trying to remember, it was a small Canadian tree company. I forgot what it was. I think it took about 4 weeks to process the event, and there was complete panic. And everybody said, God, thank God it wasn't General Motors. General Motors was a 2-day event.
Go ahead.
If I could just ask a quick follow-up. Can I get your thoughts on sort of interoperability among CCPs and among market infrastructures?
I think interoperability is a question that gets a lot of play. I think that there possibly are places where it is, I think it depends on how you define it. And depending on how you define it, there probably are places where it is relevant. I think it is important for example, CCPs to be able to interact with the trade information warehouse. I do think that one of the things that I have failed to point out so far during that part of the discussion is that different clearing services are structured in different ways, so they actually need to interact somewhat differently with the warehouse. The question that you were raising, Steve, about the difference between the open positions shown in the warehouse and the open positions shown in clearing. In the case of our clearing service for credit, the trades no longer exist in the warehouse once they have been cleared. And so the relevant piece of information to be put into the warehouse as a result of our clearing service for credit would be the net position that you have left. And so there wouldn't be a difference between the kind of cleared open exposure and the warehouse open exposure if people are reporting it based on the net open position. So I think that there are some cases where entities need to be able to interconnect. I think interoperability as a matter between clearinghouses is something that is more complex. That brings with it credit risk between CCPs and interdependence on the risk management regimes of different CCPs, where there can be differences in the way that services are constructed, there can be differences in the way that margins are calculated, there can be differences in the balance between margins and the guarantee fund process. And done inappropriately, the interoperability between CCPs can actually create more systemic risk rather than helping to reduce systemic risk, which is really the goal of the clearing service.
From a client experience standpoint, one thing that we've seen, especially in CDS, working with both with Kim and Chris at CME and ICE for our end users, is the functionality and the clearing systems and, all of the, margin requirements that the CCPs mandate, that's obviously their business, and they, obviously compete in that space. But from the actual ability to reach the clearing destination, I think the interoperability is very good, mainly in the fact that, when a client decides they want to clear at CME or ICE, we're able to give them direct access to both clearinghouses. They're able to see, in an almost real-time format, the status of their trade from execution to DCM acceptance to the ultimate clearing of the trade happen, and the actual experience is very much the same. So obviously there's going to be competition on the merits, and that's a good thing. But I think that the final result is a very fair and very good outcome.
Yeah, I would agree with the comments that Kim made on the complexity of, if you're talking about CCP to CCP interoperability. I mean, fundamentally, before we even get into the technical merits of that, and I'm not sure this is the place to do that, but philosophically, Dodd-Frank was pretty clear that we should move as many of these OTC products into a world that we had become accustomed to. And the safety and soundness of, we'll call it the FCM futures model, whatever you want to look. It's not exactly one size clearing isn't going to fit all. We talked a little bit in the earlier morning session around some of the challenges around that. But before we even get there, we're going to start having an experiment in top-down market design. Seems incredibly dangerous. I mean, the legislation asks us to go one place. We're now mandated to go there. The regulator's job is to provide us some rules of the road of how to get there. And before we get there, we're going to think about going in other directions and expanding the scope of that. And from my perspective, I think it's an incredibly dangerous track to go down.
I think that at the current state of clearing, interoperability is not feasible. To the extent that I'm talking about derivatives interoperability, right? I'm not talking about cash. I think that can be done in cash. On the CDS side, right now, to the extent that we have CCPs that have different membership requirements, different risk frameworks, sometimes even different actually underlying instrument, it is very difficult to think. And when I'm talking about interoperability, I'm talking about the full interoperability that says Tom and I trade, he decides to go to CME, I decide to go to ICE. That is like playing a football game. He goes to Stadium A and I go to Stadium B right now. We cannot meet. So it doesn't work at this state of clearing. In the future, perhaps if we can do that, that's fine. But I would agree with Chris that I think our number one priority is to actually first get the trades into clearing, get some confidence that actually we can do this correctly, and then we can worry about whether we can actually achieve interoperability or not.
Yeah, from an economist perspective, I mean, there are tremendous economies of scale and scope in this business, whether it's due to netting, diversification effects, and so on. So I think that there is going to be a tendency for migration to a single clearinghouse or a small number of clearinghouses. How that migration takes place will in part depend on if there is mandated interlinkage between them. But the one caution that I would make is that we sort of had mandated interlinkage in the equity market, for example, and we saw that under times of stress, like on May 6th, that's when those linkages break down. Well, the whole point about clearing is to basically deal with those stress situations. So I think you have to tread very carefully with looking at interoperability and particularly mandated interoperability in clearing.
Let me ask a question about competition. And I think while there may be very healthy aspects of competition, it's also possible that there may be unhealthy aspects of competition, specifically CCPs competing on margin in a race to the bottom. So what suggestions do people have for the regulators to make sure that this doesn't happen? Should we, for example, I'm not suggesting it, but should the regulators mandate a particular margining methodology that all CCPs have to use?
Could I hop
For
in
credit.
there? And if I may, I'm sorry. I think this question is tremendously well linked to Kim's comment earlier about systemic risk and to the earlier comments in the morning session about a race to the bottom. In an earlier comment, I noted that each of the CCPs is an independent business competing on its own merits and developing its own proprietary practice models and practices for risk management. Whether it's clear that Dodd-Frank mandates clearing of all, or how we define all eligible CDSs, or requires the bringing in of as many things as possible. I think one point not to miss, and that is more obvious than all of those, is that the systemic risk that arises from some negative aspects of competition, the negative externalities that can arise in the business, should not be overlooked. And here's a place where I think there is a tremendous opportunity for the regulators to act innovatively, in that while it is the case that each CCP is its own business and will develop its own models and practices, there has to be, for normative reasons, a threshold beneath which no competitor is allowed to sink. And the purposes there are to ensure that all the benefits of the multilateral netting are captured without bringing into the picture the negative externalities that will certainly arise from ineffective pricing or risk management practices.
So, yeah, if I can, I think there's a couple of things to think about. I don't think it makes sense to say we're going to mandate that you all use the same margining process. I think if you do that, you potentially lose the benefits of innovation. You lose the benefits of having different people looking at the same problem and coming up with a different answer. And there may be different reasons why one CCP decides to margin differently from another. One of the questions that also comes into that is not just margining, but how do I break between the IM and the guarantee fund, and how do I break between what's funded in the guarantee fund and what assessments rights are and how much that is. So I think it's more important to ensure that there's transparency as to what standards each CCP is using, that there's enough enforcement to ensure that CCPs are in fact meeting the standards that they have set for themselves. And three, ensuring that to the extent you've got reliance upon assessment rights, that you can reasonably expect that your non-defaulting members will have the liquidity to pay those assessments, in a timely fashion when you have the default of another member.
I was going to ask a related question, which is obviously there has to be some ability on presumably there has to be some ability on the part of clearinghouses to innovate, apply their own methodology. What happens in a situation where, leaving aside questions about valuation, if you had very similar products traded on more than one clearinghouse, in the event that just the amount of margin collected is significantly different in one case than the other, what would that say, if anything? What would it say from a regulatory perspective? Would it suggest that should that raise questions, alarm bells? Should one assume that if people are following good, prudent risk management purposes, that those ought to be fairly similar?
That has happened. And I think if one exercise might be helpful is to go back and look at the times when that's occurred in various products, and to try to determine what's going on. I think what's the motivations now might be different from where they were prior to 2008, but there's no doubt that competition among clearinghouses it's a relatively new phenomenon, and there's no question that one cost factor is margin, and one cost factor is correlations. It's a deep question that is worth thinking about. But I think one thing we know now is that the level of activism to understand what's going on by the regulators, and the level of expertise in understanding how those numbers work, there's a need for a greater focus on that, especially as clearing becomes such a central feature in the financial system.
I think one thing to think about is you do get those anomalies from time to time, and I think we talk a lot about competition and multiple clearinghouses clearing the same product, but I think we'd be very careful we do have genuine competition. That if you think about a CCP, they're trying to set margin levels based on how do they go and commercially win the next trade to be cleared, and how do they risk manage the existing trades. The next trade for the individual user is more driven by correlation, the impact on the default fund contribution, a lot of other factors other than just the margin going to that decision to put a trade into an existing clearinghouse. I think if you want to have competition on margin levels more generally, interoperability probably isn't practical. I think everyone's struggling in the cash markets to make it work. Maybe in 10 years' time we can also come back here again and have a debate about OTC interoperability, but we're probably not going to get there at the moment. But giving people the ability to move trades between clearinghouses, I think is quite important. If you pick a clearinghouse today, you leave that trade for 2 years, if you and your counterparty agree you might want to move those positions, you should be able to do that. And that would, I think, in itself create enough competition to iron out some, but not all of these anomalies on margin. Otherwise, in practice, there's going to be no market pressure to fix some of these things.
Yeah, to talk, oh, go ahead.
Just to touch on a couple of points, I agree with a lot of what my co-panelists have said, but to go back to something Mike said earlier, in the earlier session this morning, it comes down to the analysis process that you force a DCO applicant to undergo while they're going through the application process, and the in-depth of that analysis process, very similar to what you have been undergoing with New York portfolio clearing. But in our view, it's not just a process that ends when a DCO gains its license. It's a process that's a continuing process that where the DCO should have to review its risk management capabilities, its risk management functionality with the clearing, with the different regulatory agencies throughout the life cycle of its clearing.
With respect to kind of answering your question about whether there could be legitimate reasons why margins would be different at two different clearinghouses looking at the same product without something being wrong with that. I would just offer a couple of points of consideration. One is that there are some kind of basic statistical tests that clearinghouses undergo in evaluating margining, and there are basic coverage standards. Tom talked about this a little bit, the standards that the clearinghouses set for themselves to be able to cover. I think one thing that would be important from the regulatory point of view is to be able to monitor whether clearinghouses are actually adhering to the standards that they've set for themselves. But I think it is not unreasonable for clearinghouses to set somewhat different standards for different products, for the same product set, given different environments that they might be operating in. They might be operating in a situation where they have more clearing members contributing to the pricing and the default management. Therefore, the liquidity that they would face would be better than the liquidity another clearinghouse might face. That's one example. They might be sitting on a book of positions that is very diversified across and kind of evenly spread among market participants, and a large number of market participants, or another clearinghouse might be sitting on a book of exposure that is more concentrated. That would affect the level to which they do margining. They also could be making a slightly different choice about the mix of resources that they want to bring to bear in a situation of a default. The waterfall could be leaning more toward margin, could be leaning more toward the guarantee fund, and both of those are very legitimate choices as long as the ultimate outcome is that the clearinghouse provides for the ability to withstand the default of the X number of market participants that is determined to be the target there. So I think there is definitely room for legitimately different decisions to be taken in looking at the margining for the same product.
I think there's,
I would agree.
there's the CPS IOSCO standards for clearinghouses or settlement systems or payment systems are out there that everybody should be subject to. The point, if there are differences, the question should be, of course you should question it. And there could be very legitimate reasons, or there could be very, not so legitimate reasons. But that's the role of the regulators. But it's also the role of the market participants. There are offerings out there where people have said, not going to go near those guys because it's way too much risk. It's not always about, believe it or not, Wall Street's not always about money and trying to find the cheapest trade to do or, to maximize the profit. We do, as I said before, we do want to survive. And if somebody's going to have you come into a risky situation, everybody will pass. When we started Euro CCP, the one thing we heard all the time, we have very high membership requirements. This is our European CAS CCP, was you're charging me requirements are way too high on me, but make sure you get that guy because he's really weak, okay? We all love each other except when it comes to trusting each other.
I agree with Kim's comments in terms of that the CCPs can have some flexibility, and I agree that the books might look different and they should have that flexibility. The regulators have to make sure that fundamental assumptions, though, are consistent. I think, to me, that's the most important element. Having one CCP assume that they can actually withstand one significant member default, have another CCP assume they can sustain 3 members default, is not a good situation. I mean, people vote, obviously, sometimes with their wallet, sometimes they vote for risk reasons, like you said, and obviously we're going to make these decisions. And there are sometimes that clearing members might not have the full picture, and the regulators have that full picture. The underlying framework assumptions that Tom alluded to, that assessment rights. Is the CCP there? Does it have, if you put $1 in the guarantee fund, are you assessed the second $1 and then it's game over? Are you assessed multiple dollars? That is a fundamental assumption. And that is what's going to have the most systemic risk impact than anything else. Some of the small stuff, micromanaging the margin, whether it's 1.9 or 2%, I think we can live with that.
But there, even in terms of the general standards,
Yeah.
there may be some play there. I mean, the international standards that Mike was mentioning are, in the views of some, are probably too lenient. It should be, stricter than being able to handle the default of the largest one. So it's will be a struggle from the regulatory standpoint to sort of figure out where the baseline is.
Let me ask a question about the specific risks of CDS. There is this notion of a jump to default, and there's also a notion of a jump from default. So the question is, currently the clearinghouses that offer clearing for CDS, what additional considerations have you put into your risk management systems to take into account the specific risks of CDS? And once you hear from the CCPs, if the others will point to other things that people should think about. So, don't mean to put people on the spot, but I'm going to be put on the spot.
Indeed, fundamentally, the risk of the CDS instruments is quite unique and is quite skewed towards protection sellers, namely from jump to default. So at ICE, specifically, we'll look at many different types of risk associated with CDS products. The first one is the so-called spread dynamics, namely how the spreads are moving upon extreme conditions without even entering explicitly state of default. That would be the first factor. The second one would be liquidity risk and liquidity requirements that should be assigned for different instruments. Definitely, as we discussed in the previous session, different instruments, they have different market activity, different liquidity. Upon extreme conditions, definitely the bid-offer width could substantially widen. As a result, we have models and we have ways to estimate the liquidity charges associated with liquidating big portfolios, because we have to all remember that the current settlement levels, they correspond to eventual mid-level that should be very accurate, and it's used as a base reference point for looking at the margin requirements and how they perform. The next type of risk that we look at is concentration charges. We have very specifically designed concentration charges that approach the maximum liability as the positions increase. For example, from a protection seller point of view, the overall margin requirement could approach the total notional on which protection has been sold, and if you're a protection buyer, then the requirement could be the full coupon payment, the forward payments. Of course, we mentioned the jump to default. We have specific sensitivity analysis associated with assumptions about the recovery rates. Typically, we look at jump to default in terms of minimum recovery rate, which is name-specific, sector-specific, to reflect the overall risk of these instruments. We look at interest rate sensitivity in terms of what would happen if the spread market performs in the same way, but there is all of a sudden significant move of the default-free interest rate. So the final requirement is a combination of 5 different risk elements, and we attempt to quantify very carefully each of these elements and build the total margin requirement, which would reflect all types of, practically 5 different elements of risks associated with those instruments.
We have a not dissimilar approach theoretically. We have a 7-factor model that looks at a variety of different sets of market conditions. In many of those factors, the margins automatically scale as the spread on the product increases. But then there are also specific liquidity considerations and specific jump to default. One of the factors is a jump to default or jump to worst credit type of evaluation. And then there's also an element in our minimum margin that considers the margin that is calculated based on looking at the portfolio and all of the different factors, as well as looking at the jump to default risk. And then there's that could trigger a minimum.
So yeah, so we have also developed a model which follows the specifics of a credit default swap, and in particular the asymmetric risk profile of the protection seller and the protection buyer. So for example, the protection seller has to post a special margin which we call credit event margin, which is oriented or calculated based on the largest exposure within a portfolio with regards to individual names. So we assume that if the biggest name in the portfolio defaults, then we assume a recovery rate of 0 and a second name with a recovery rate of 40. So that reflects the credit event element. And on the other hand, the protection seller, of course, has the risk or carries the risk of the accrued premium margin. So this is also separately margined. So to characterize or reflect the characteristics of this asymmetric risk profile between protection seller and protection buyer is reflected in our margining methodology.
Can I just ask, maybe just to provide some context for those 3 descriptions, can you give a sense of how your models have changed over a period of time? What have you learned from the process of introducing the clearing of these products? And what areas are you still thinking about, either in comparison to the other platforms in your own modeling, that are issues you expect to face in the near future?
I think, if I may continue, I think the margin methodology is only the way to make sure that in a default scenario you have sufficient margin. What is ultimately important is that this model is strong against stress testing. So if you do stress testing, testing your margin methodology against what can happen, and that is, from my perspective, the ultimate way to make sure that there is a consistent methodology or consistent approach to avoid race to bottom on the margining side between clearinghouses, that all clearinghouses have to ensure that, for example, they are compliant with a 99.9% confidence level with their margin requirement and their clearing fund. And I think what the regulator could do is to define those stress tests with some more detail to avoid this race to the bottom, because there are many assumptions in those stress tests which ultimately make you comply or not comply with regards to the margin requirement. I think the margin methodology itself should stay with the clearinghouse, because the more sophisticated you are on the methodology side, the more you are aligning yourself with the curve of the stress test, which then is efficient or brings efficiency to the market. So I think the regulatory side should focus on the stress testing of the portfolios or the margin methodology.
Yeah, I would completely agree with Matthias that the main thing is there should be some flexibility in terms of how the guarantee fund and the margin requirements are set, but the ultimate test should be what is the stress test scenario or set of scenarios that we want to be protected against. And extending that discussion, I would say that, for example, at ICE, we look at 2 simultaneous defaults of the 2 biggest losers upon extreme conditions, and then assuming that 3 single names in those portfolios in which they wrote protection would be defaulting at the same time. So overall, the stress test scenarios used to determine the size of the guarantee fund would correspond to up to 8 simultaneous defaults, which is very extreme type of realization, along with additional widening and tightening. In terms of definite skew of the risk profile, the margin requirements at ICE, for example, they're about 3-to-1, even more skewed towards protection sellers, which are the main sources of systemic risk. In terms of evolution of the systems and the models, the main thing that we're focused currently is how we account for basis risk and how we provide those single name versus index benefits in an efficient way without making it prohibitively expensive to maintain a flat risk profile. Because on the other hand, if we don't have the proper portfolio margining, then it disincentivizes the clearing participants and overall clients of the clearinghouse to maintain flat risk profile, which would be the ultimate goal, because the clearinghouse, when deals with less actively traded instruments, would be able to more easily unwind such portfolios upon auction.
At the risk of getting a little heavily into the weeds on this, and if there's a lot of stress being put on stress testing as something that can provide comfort, is it presumably the meaning of extreme, and extreme conditions could be different, viewed differently across different firms. How much, from a regulatory perspective, can practically or should the regulators try to make sure that those things are defined similarly? I mean, in terms of it can be different depending on sort of the historical horizon you're looking at, the number of kinds of factors you're looking at, the number of factors. How should we look at that from a regulatory standpoint, if anyone wants to?
I mean, I think in some respects there are examples of previous behavior where that stance has already been taken, where, either through launches of new products or certification products and of new products and things of that nature, where regulators, CFTC specifically and SEC as well, have asked how certain assumptions being made around the management of these instruments would have behaved during historical points of reference, be it Lehman or some other high water mark that's out there that we want to make sure that's cured for. So, I would offer that you're on the right trail with that. You got to get a level of comfort that that you're asking the right questions around that. But can we solve things that we don't know? I mean, we're going to use a historical reference point to get there and say we're better than it was before. We've learned, we've made improvements. The process has given us now a better market in which to operate. So I don't know how else you would get to that point. Now, it'd be up to you to make the determination as the regulator whether or not the answer you got was sufficient. But, certainly those are the questions.
I could give you a couple of things that we haven't experienced yet, but I think it is something that you might want to consider going forward. For one, I think it's clear that if you compare CDS, and that's what you asked, comparing CDS versus other asset classes, it clearly requires a longer unwind horizon. So you might need a few hours or a day for Euro-dollar futures, but you need probably a week or two for CDS, and depending again what we look in there. The second thing that is actually unique, we haven't done that yet, is correlated sequential defaults, which is, especially as we get into client clearing, I think we're going to have to worry about the situation that a large client defaults, the FCM, and again, it goes back to membership requirements and all that stuff, is unable to handle that client default, and as a result defaults itself. That actually increases, there might be CDS trading on that time, that increases the values for everybody else, and then you have to worry about how to do that unwind. Okay? That is something, again, that we haven't experienced, but this has to be on the radar. And then lastly, there has to be consistency in terms of decision making, and it goes back to what we mentioned earlier about the termination committee. There are events that have to be...
So, Thanasi, you're saying both the client and the firm are names?
Yes.
Okay.
Well, it could be one or the other. I mean, that would be a scenario, but obviously, I'm giving you the worst case scenario, right? I mean, but either way, you have to worry about the client, first of all, the FCM being able to handle the portfolio, because if they don't, then they default, and then we have to basically figure out what to do with their portfolio. And the last thing, the termination committee consistency. You need to ensure, first of all, that, when we say, in general, we tend, most market participants, at least on the clearing members, which you care about in terms of managing their default, they tend to run pretty small net books, but very large gross books. So you want to ensure that there is consistency, obviously, in terms of the treatment of these trades, and you don't want to have a situation that CCPA says GM defaulted, CCPB says it didn't default. Okay? In in that scenario, right now, the current CCPs obviously are aligned in that respect, but you want to ensure that if a new one comes up, they don't have the option to say, oh, I won't listen to what the determination committee says, I'll do my own thing. Because also remember, as the default happens, clients will be moving positions from FCMA to FCMB or potentially from CCPA to CCPB. And you need to ensure that those things are going to move smoothly. So these are things that have to be on the radar. And again, as I said, the new things, we haven't dealt with them before, but we have to think about them.
And how, as a practical matter, does one do that from a regulatory perspective? I mean, is it enough to sort of make sure that the sort of machinery or the type of process that's in place in terms of determination committees and making those decisions is roughly the same across clearing agencies? I mean,
well, the determination committee one would be easy. There have to be a commitment, an absolute commitment from the CCPs that they will abide by these decisions like any other member of the trade. It is written in the rules and it's written in the contract, and then there is actually no optionality. That makes life easier. Some of the other stuff I described actually is much more complex. At least that one is the easy one. We can say, we can hold that is the case.
So just to be clear on that, so the ISDA Determinations Committee, under the contracts, as part of the changes, CDS have been standardized, I keep saying this for 10 years, we've made some changes to those standards. One of those changes was to move from bilateral agreement as to things like successor events and credit events to the ISDA DC as the place to make those determinations. So there's a determinations committee, with representation for buy side, sell side, that turns over time, where the decision is made. And so I think what Thanasis is talking about is having that determination committee be recognized as opposed to separate determination committees that might all reasonably look at the same situation and potentially come to a different answer.
So that would presuppose, I'm not suggesting it's inappropriate, presupposes regulatory matter that we're in essence looking to a private sector sort of organization for making those determinations, suggesting clearinghouses should reference those in each case.
Yeah, I think so. But if each clearinghouse has its own, those are private sectors. Generally, those are private sectors at this point anyway.
Right.
Plus, we've gone now through about, 60 or 70 credit events, and that process actually has, one thing we can say about the crisis, one thing that worked well, that was it. So.
But there are real sort of legal concerns with looking to ISDA as the determining body for these issues. While I think there are obviously economic efficiencies and certain operational benefits for having the determinations committee of ISDA make the decisions for the industry, and so that there are not sort of competing interpretations of what's happening, for the regulators, the reliance on ISDA is politically less easy or even legally less facile, in part because ISDA is an independent, non-governmental agency that doesn't have immediate accountability to a federal agency or particular standing under any sort of specific jurisdictional rules in the many jurisdictions where ISDA's sort of policies certainly sort of direct the market. So there is sort of a gap there in taking that step that is something for the agencies to look at very carefully.
Picking up on that point, we've been focusing on the product documentation to some extent in the determinations committee around credit events, but I was wanting to solicit the group's views on the relationships between the clearinghouses, members, and customers in terms of documentation, the sort of master agreements, but also client arrangements, give-up arrangements, and ideas about how those documentation issues could be addressed with the overarching concern about access to clearinghouses for customers, the client clearing initiatives that have been underway.
Let me jump in. I think a good place to start when you look at cleared product is to look at where the other cleared product is in the listed derivative space. So, there is precedent for clearing agreements and for, give-up agreements that various bodies have put together, from the listed derivatives experience, and they're pretty good. And they're pretty simple, they're pretty symmetrical. One of the things that we're looking at is is the current execution, give-up agreements that are in place there to draw that experience from. We should be mindful that the agreement shouldn't be overly complex. It should just really deal with the facts and the issues themselves. So standard clearing agreements, again, it's a good place to draw from, is from the listed derivative space.
I mean, I would add that, prior to the legislation, right, the world was much more gray. And at least the documentation that we employed at ICE Trust was one to remove that gray area. And we did that in the form of a standard terms annex. Now that we have legislation, and with the implementation of the rules of that legislation, and there will be opportunities for us to move with much more legal certainty than existed prior to a more standardized documentation that is consistent with the FCM or agency-based model that, in our opinion, based on the regulatory construct which we operate, were not available to us and introduced more confusion than it was worth at that point in time. Certainly those standard agreements that Jamie makes reference to, in that they've been negotiated between clearing members and their customers for their entire existence, and they've become form-like in some respects, and they've moved along to serve a very specified purpose. There is still a bilateral nature in those agreements of what the clearing member and the risk around the clearing member is willing to accept on behalf of those individuals. That's not necessarily a CCP issue. Our issue is to make certain that our rules govern the product and the behavior of the participant in a consistent manner. And we're certainly moving the transition into that new documentation that's now, for the first time, available to us under this.
I think we brought our service to market under the FCM model originally, and so the documentation process, I think, was much simpler than the documentation process that needed to be followed in some of the other cases. It was an annex to the futures agreement. I would expect that that's going to be the way that things will move forward under the new legislation and regulation. I would like to say one thing about the give-up agreement, though. I think there definitely is a time and place for there to be a complete industry standard around certain things. I would say the determinations, the committee is a good example of that, where you don't want necessarily different outcomes from the same set of facts about whether there's a credit event or not. But with respect to things like the give-up agreement, I think that there's a tendency by the industry that has long been an ISDA-governed consensus-based process that they don't do anything differently unless everybody agrees. And in the case of the give-up processing, that is an operational process. It's a credit process. It's a part of the service that is an example of something that could be innovated on by one or more CCPs in slightly different ways to provide an efficiency to the market participants. And having a process that says that type of thing has to be governed by an agreement that everybody has to agree to before anybody can innovate is probably going to stifle the ability of the marketplace to respond to changes in market conditions and provide innovative services.
I mean, one thing I would say, and I don't think we have much in the way of end user representation here, but I think from an end user perspective, as we've gone through and from all of the dealers, the sell side, we've all had negotiations bilaterally with clients, working with multiple clearinghouses and working groups with end users on what these agreements should look like. And I think one of the things we found out is that as clients are going over the detail of the existing futures agreements, they're starting to see things where they say, well, you know what, I don't really like that. I kind of want to change that. I kind of want to change the way that works. And I think, as a whole, as we've gone back and said, look, we need to take derivatives. Derivatives are a 15, 20-year-old product. We need to modernize them. We need to make them safer. So we're going to put them into clearing. We also need to look at clearing and realize that clearing hasn't changed that much in a longer period than derivatives have been around. And so from the perspective of the OTC swaps market, people are very used to being very documentation intensive and going through and looking at all of this. And as people went through and started looking at clearing, we found that we've had to make a lot of changes, and a lot of those we've worked with the clearinghouses on and elsewhere. And so that's still ongoing. And from an end user perspective, they're still looking at those issues as well. So I think it's important to remember that, we need to move the documentation along, but we need to take into account all of the relationships and ensuring that as we move swaps, we take swaps which haven't been in clearing and we put them into clearing that was originally developed for products that are very different, that we're sure we make the changes that are appropriate for that.
Could a possible solution be for the regulatory agencies to prescribe documentation? If there is no consensus, and if you assume that you want to get to a state of affairs which is clearing by a particular time, and if you leave it up to the market participants and nothing happens, should we prescribe something?
But to Kim's point that she made a little bit earlier, I mean, part of the function in that documentation relates to a number of different bits and pieces between the relationship, credit being one of them, that's being extended by the clearing member to the end user. So while you might be able, as a regulatory authority, to assign certain minimums that documentation must include, being overly prescriptive in that I'm not sure you're ready to wear that risk.
I think the industry is already incentivized to actually get this done quickly, both buy side and sell side. And I think we're all incentivized to ensure that we define the common things that we can put in a document that they can apply to everyone, because that makes for a simpler document. And obviously, to the extent we still manage a bilateral relation, we still need to maintain that flexibility to manage that. So I think that is something that people are spending a lot of time, both in also with trade associations, etc., to actually get that done. So I agree with Kim's comments, obviously, that sometimes we take too long. It's like herding cats, but we'll kind of get there.
Yeah. Speaking of incentives and disincentives, both the SEC and the CFTC have the responsibility to set margin requirements on those entities that will register with us as dealers and who are not regulated by the prudential regulators, i.e. the banking regulators. So how should we do this? On the one hand, I'll come on and ask. It's been on my mind for a long time.
You each get 2 minutes.
How should we do this? And the considerations are one, you want to make sure that there are incentives to clear, right? Number two, at the same time, I guess there will be some products that just cannot be cleared and will remain bilateral. And what is the balance? You don't want to be punitive. And I guess the question can be asked on different product classes, but specifically with respect to CDS, how should we do this?
But you're right in saying that incentives. First of all, let's look at the current state. We have tremendous incentives to clear. If I face a counterparty bilaterally versus actually having the same trade in a CCP, I get a tremendous benefit in terms of the capital that I have to set aside. So that incentive is there. The part that would worry sometimes is if, when people use the word incentives, if they say that the risk is X, capital should be 3X instead of X. Because if you do that, you create incentives, yes, on one side, but also you will actually create the incentive to put things in the clearinghouse that perhaps shouldn't have gone there. So that is the kind of the fine balance that you need to worry about. Because the second thing is, I think you correctly said that you are going to have to look at those counterparties that actually are not already regulated by prudential regulators, and obviously you don't want to create some new loophole there as well. So looking at what are the current capital standards that already apply to some of the rest of us, basically, that already have to pay those prudential capital requirements, is very important. So it's consistency that we care about, obviously.
We've been dancing around, a lot of the comments here have sort of been dancing around issues involving the interests of end users, but I'm not sure that we've really kind of addressed that sort of head on. So I guess maybe I'll sort of ask a general question, or maybe preface it by saying that I think perhaps a fair reading of legislative history and the congressional intent could be to suggest that this market, the swaps market in particular, not necessarily CDS market, is overly concentrated in terms of market share. That part of what we ought to be doing through the exercise of the regulatory authority in clearing is to open that up, to make it more competitive, to provide access more readily to a broader class of people, including to end users. if that's a fair read, then how should we as regulators go about it? How should clearing agencies provide access to end users? I'll start there. Anybody want to?
Why don't I jump in? As representative of the SDMA that represents independent dealers and FCMs, I think you look to the Act and you look to the core principles of the Act in terms of open access. And I think away from the core principles of the Act in terms of open access and requirements for transparency and so forth, you look to the prudential nature of the risk inherent in any system that is too focused and too concentrated. So what role then can more FCMs, again, properly and adequately capitalized, what role can they play? Well, within the FCM, within the clearinghouse structure, they can burden some of the risk and they can distribute that risk. For independent dealers to provide a liquidity or additional liquidity into the system, that can only bring greater stability in the system, especially in times of crisis when you need it most. More people coming in, making more markets and more products is simply better for the system overall. So again, you've got to ask yourself from the clearinghouse standpoint, what can be done to bring in entities who are well capitalized, who serve and who are very active in the same clearinghouse in other market contexts, but are thus far not yet set up in this system. So, and there's initiatives right now that are going on where that's changing, which is very good. But again, where you have the way in which liquidity and market making has evolved in this marketplace over the past 2 decades since the inception of, interest rate swaps and most recently credit default swaps is really on a dealer-to-client basis governed by an ISDA. And that market structure is going to change because you have a sort of flattened multilateral prospect where not only dealers to dealers trade with each other, but also dealers to customers, and indeed customers trading with customers. So again, you've got when two parties come together and they do a trade, the byproduct that they throw off on that trade is liquidity. So that should really be encouraged.
I would slightly question your underlying assumption in terms of how competitive the market is. If you look at this industry and you compare it with other industries that are actually extremely infrastructure heavy, you have, I think, you look at something like buying cable service, buying a telephone, buy whatever. You don't have 15 dealers, obviously, competing over one another for fractions, sometimes of a basis point. So that's kind of, but I'll answer the question anyway. The issue is that we think it can be open access and there should be free competition. Whoever comes into this framework should come in with the same rights, but also with the same responsibilities. But then the market can compete, and I think clients are going to freely go wherever they think someone offers them more liquidity. In terms of CDS in particular as an asset class, you do have to be cognizant of the fact that it is more capital heavy as an asset class. It is something that's subject to jumps, so that the participants that are in there will have to be cognizant themselves that they will be subject to those jumps. And that is what has basically weeded sometimes participants in the past. In the good times they get in, and in the bad times they get destroyed. Again, the market forces take care of that on their own, but it's not for us to prescribe. But I don't see that there are any barriers in this sense. Clearing definitely even lower any barriers. Anybody will compete because they can equally go to the clearinghouse, and then you can trade with whoever you want. And I think we'll see that.
I think one thing, you asked the question about how we bring more end users into the marketplace, and I think they have somewhat different issues than maybe some firms like Jamie that want to be FCMs, that most end users who haven't traded derivatives, if you sit down with them and say, why do you only trade futures and not derivatives? The main thing they're worried about is uncertainty. They look at the OTC asset class and they get nervous about a bunch of things. They get nervous about legal certainty of the trades, they get nervous about the documentation, they get nervous about the marking, a whole bunch of things, and that discourages a lot of people from trading derivatives. And if we're going to encourage more of those people into the market, that's probably a good thing because they have economic risks they need to cover. And there's more people in the market, there's more liquidity. It means there'll be room for more dealers to cover the infrastructure costs that Thanasis was talking about. And I think that's the fix to the problem, is just to make the marketplace bigger. then you need to, I think, spend more time with the pension funds, the traditional money managers, the people who have lots of economic assets but choose not to use OTC derivatives to hedge them. Most hedge funds do, so that's not really the issue. Those guys are looking for certainty in the course of the trade, and they get very nervous about, I do a trade, then is it enforceable or not enforceable until it gets to the clearinghouse? They all have different views about what the answer should be, but what they're looking for, I think, out of this process is a lot of certainty about every step in the trade. Some of them love ISDA documents, some of them hate ISDA documents with a passion. I don't think it's anyone's job to tell them what they should and shouldn't like in terms of documentation, but I do think at the end of this process they want a world where they understand the risks they take, they understand what happens if there's a credit event on the trade, they don't have to worry about those things, and I think that will encourage more people in. At the minute it just looks expensive from an infrastructure perspective and creates a lot of doubts in their mind about what they're doing. And I think if we can solve that through this process, more people will come in, the market will grow, you'll naturally get more dealers because it'll be more attractive, and a lot of the good, that liquidity breeds liquidity and we'll end up in a much better place. But often we talk too much about dealers and mid-sized dealers and clearinghouses and forget the market is actually driven by pension funds, traditional money managers and others in the credit space that actually want to trade the asset class, and they have a very different set of needs.
One of the things we're seeing from our buy-side customers today, and this is dramatically ramped up since July and the passage of the Act. The two main tenets of the Act, with transparency and then obviously clearing, that in of itself is bringing back two distinct customer groups. Number one, customers who prior to 2008 had been using OTC derivatives either in small or large scale, but then also new participants who had never been involved in OTC at all, who now have a strong interest, mainly because of the fact that the mitigation of counterparty risk is, from what we hear, probably the primary driver. But then secondly, with the tenets of transparency, the fact that there's going to be so much more data available, whether depending on the rulemaking, whether it's close to real time, close to end of day, whatever it ends up being, it's going to be dramatically more than what we have today, and that in of itself is going to bring in participants and liquidity into the markets.
My experience with end users, companies that are hedging or mitigating risk and embedded in their businesses, is all this is true. But the bigger issue is cash. And the biggest uncertainty is having to post margin, and they're watching their businesses go down in flames for lack of cash, because they're not banks. They're not pension funds. They're airlines, they're utilities, they're whomever might be hedging the risk. So that the biggest concern with entering into of limiting themselves to a clearing environment is that they lose access to bilateral transactions in which debt or credit extension is embedded. So that's the real driving factor in all of this, which leads to the question whether a system that is bifurcated, where you have the clearing system and FCMs extend credit, and where you have another system where banks embed credit deals in derivatives, is a good system. But that's the system we're in, and that's what will the less attractive the embedded credit deals in bilateral transactions is, the more clearing will occur.
Right. So some would suggest that those contracts that the credit extension embedded in the price, but embedded in an opaque way, in a way that's not ideally most efficient.
Really? I've never heard of that.
Some would suggest. Does that prompt any suggestions about, in terms of the machinery of the clearing house, representation of end user interests? Is it appropriate to have a specific end user representation on the board, on the risk committee, on sort of key?
Maybe more creative ways to. I think this is all about credit. So the more creative ways to provide credit into the system, so that credit for margining can be accessed. And the other thing is, of course, less lack of transparency on the other side.
I just wanted to go to your sort of the premise of your question, which was about the markets being concentrated, and there was sort of an implicit assumption there that they were too concentrated. Well, I think it's important to recognize, I think, first of all, you should ask the question, well, why did they get to be that way? Are there fundamental economic factors that are driving that? What are those economic factors? I can think of some good ones, and I can think of some bad ones. For example, sort of too big to fail subsidies could be one thing that would be encouraging excessive concentration. But on the other hand, I can think of good, just sort of economy and scale of scope reasons that are leading to this kind of concentration. And I think it's important to start from a fundamental understanding of what the economics are, as opposed to saying, oh, the market's too concentrated, let's force a less concentrated structure, which might actually be sort of going against the underlying economics and force on excessive costs and perhaps excessive risks.
I think one of the points that I hear raised often as well, the standards for membership are too high. And there are sort of two factors on that. One is to talk about the financial requirements, so, net capital. And two is points around the need to provide daily pricing for CDS clearing, and to participate in the unwind upon the default of a counterparty. And I think you have to think about this in the terms of, the questions about what should be mandated and how far do we clear, and questions about this are directly tied together. So the fundamental principle behind a clearinghouse is we have sufficient daily pricing that we can know what the variation margin should be. And by having sufficient daily pricing, we're able to calculate an appropriate IM and an appropriate guarantee fund to ensure that we're safe. If we have products that are liquid enough in that clearinghouse that you don't need to rely on the members for daily pricing, then that's going to lead you to a different answer for what your membership standard should be. If you have products that aren't liquid enough, if you look at some of the DTCC statistics they have published on the 9-month study that you guys did on trading volume, well more than half of the 1,000 single names they looked at had less than 5 trades a day across the entire curve. So on a 10-year curve, 4 points a year, 40 products per credit, there were less than 5 trades a day. So, and the way I think about it is, it should be open access, but you need to have certain standards to get a driver's license. And those standards change based on the type of vehicle you're driving. So if you're just going to drive a car, there's one set of standards. If you're going to drive a Mack truck, there's a different set of standards. And that means regulators kind of have a choice. And I think part of this is, what was intended by Dodd-Frank. But if your choice is to say we're only going to have clearing of the highly liquid products, that's going to be a very narrow interpretation of what's cleared, and you're going to end up with a broader set of those who can handle the client risk that they're taking on and they're introducing into the system, and who are able to participate in the risk management of that system and the mutualizing of that risk between members. If you go for a broader set of what's to be cleared, which I think it seems to be what everyone thinks is the intent of Dodd-Frank, and certainly from the approach of the clearinghouses is what they're targeting, then I think you have to set a narrower standard. You have to set higher standards for who's able to participate in that. And that's all really based on this issue of how liquid are the products that we're clearing, and do we have enough pricing externally that we don't need to rely on that from the members.
I would just add that part of the concentration is certainly the result of the adoption of the Commodities Future Modernization Act in 2000 and the definition of eligible market participants, and or in combination with the Gramm-Leach-Bliley Act's removal of those sort of into an unregulated zone. So I think some of the concentration was largely the part of legal construct limiting who could actually participate in the market. And that legal construct was based in part on what Tom is mentioning, the concerns about liquidity in the market and the ability of pension funds or other sort of more sensitive types of investors' abilities to access the opportunity to liquidate the positions if they needed to in a particular emergency.
I think there's another dimension to access. One is access to clearing membership, which Tom, you just talked about. But the other dimension is the access of end user or clients to having their products cleared. Right? In the futures model, everybody has access because you got no choice, right? You trade a futures contract, you got to clear it, right? Either you do it directly or you do it through an intermediary. So the question I have is, I believe that is not enough client clearing for credit right now. And tell me if I'm wrong, and if I'm wrong, why is that so?
Well, we couldn't tell you it's wrong because there's not enough client clearing. So that's probably the easiest part of the debate today. The fact that for credit clearing, it has taken us 3-4 years to actually get it done, it's because it is truly complex. We're dealing with the underlying instruments complex. We had to work out a lot of issues. Obviously, the moment we introduced client clearing, it raised the complexity by another order of magnitude, because suddenly we are dealing with, instead of 3 parties, we're dealing with 4 parties. Part of the issue we had was that actually we're dealing with participants in multiple legal jurisdictions, and we had to face multiple bankruptcy regimes and try to figure out how to work all of those. Now, one good thing coming out of Dodd-Frank is actually, because of the imposition, for example, of the FCM requirement, is that it simplifies some of that framework, and therefore now we can go back and deal with an easier framework, and actually I think we're going to be more successful in that respect. So that's why it took so long, but I think we have some concrete steps in front of us to actually get this done.
I think one of the issues that we're all facing is that we're all trying to hit a moving target. A lot of what Tom said is very, very applicable. It definitely serves the customers better, and it serves actually the clearinghouses better from a risk management point of view, to have a more diverse group of clearing member participants, as long as that diverse group of clearing member participants has the capacity and the expertise to perform the functions that we're asking them to perform. And right now, the set of functions that we're asking a clearing participant in a CDS offering to perform include some functions that are probably not widely available. There isn't a huge universe of entities that are able to perform those functions. As the markets become more transparent, more widely traded, particularly certain products, I think, will adapt more readily to the electronic execution. I think we need to have a set of standards that will allow the market to evolve as the standards to evolve as the market evolves. In our particular case, we've got a much lower minimum capital hurdle to be a clearing member than other clearing providers for CDS. Over time, that's likely to be an operative hurdle. Right now, I think the operative hurdle is the expertise and the capacity to perform things like participate in the pricing, participate in the default management, stand ready to take your share of a portfolio that we need to liquidate. And there is not as large a universe of participants as we would like who are able to do those things. And I think that will change over time, but I would encourage you to think about that evolution as you try to set standards, because you're trying to hit a moving target too.
Yeah,
If I can-
on that point, someone calls you up and say, and I get these phone calls from time to time, I'm a CEF. Really? Okay, and you have to provide open access because you're a clearinghouse. I'm like, I'm aware of what the statute says, but you haven't yet determined what a CEF is. And I draw that analogy because as it relates to the buy side and the interest they have, they're certainly interested in the protections that are provided in a CCP and the functions that collectively some of us in this room provide. They haven't yet been able to, much like you haven't been able to yet put your arms around exactly what a CEF is, kind of know it when we see it. They know that is coming. They are anticipating the delivery of those services, but yet they need to plan for that. They need to understand what the requirement will be on them. They need to understand what their capital planning process, how it's going to be modified and changed. Some of them will change their business models, and they will have to, by definition, change the business models in which they operate. We don't yet, to Kim's point about a moving target, we have not yet provided enough information. Dodd-Frank, the passage of that and the execution is now law. The next step in the next iteration of this process is going to be the rules that these agencies, your agencies, develop and provide. And we will look back on this in 2 years and go, well, it was all just. Of course it was. We all just knew that. But right now, we're in the middle of mixing the batter, so to speak. And that is as frustrating for the buy side as it is for anyone else who's materially involved in this. But at least we've removed the uncertainty around whether or not we're going to have to or not going to have to. But that's only one piece of this puzzle that is a significant puzzle that we're all playing a piece in.
I'd like to discuss or respond somewhat to Kim and to Tom's comments about requirements for FCMs and openness and what qualifies. I think certainly, we're not suggesting for a second that there should be two sets of rules for two sets of FCMs. What we are saying is that yes, capital is an issue, and sophistication and the ability to trade and participate in the auction process in the event of an FCM is vital for the success of a clearinghouse to operate. But there are, and I think you'll agree, several clearing brokers or FCMs out there in excess of 20 to 30, 40 billion capital who exceed your requirements, who from a capital standpoint are certainly eligible to participate. There's also innovative ways in which, and Tom, to your point, you can never have enough pricing when it comes to liquidity, when it comes to a liquidation situation. So if a clearinghouse is offered from other dealers who are seeking to enter the space, who can provide liquidity and put their money where their mouth is and take some of that burden and wear some of that risk, I think it should behoove us all as an industry, given the nature of this whole process, that that discourse should continue. Such that you bring in greater prices, more pricing, more dealers, more FCMs to participate in the process. When it comes to the auctioning of positions of a distressed FCM, I think it's fair to say that you can never have enough participants in an auction. So, what I would suggest and what we've contemplated is very simple, is open up that auction process to include the buy side, to include 400 to 500, 600 accounts. There is precedent in the marketplace today where auctions operate in a timely and efficient manner when positions are auctioned off in the market space today. So there is precedent out there. There are many people who wish to participate in these auctions. The buy side, new to independent dealers, old dealers of credit. There's no monopoly of information concentrated in a particular few firms. So again, there's a number of guys out there with capital who wish to participate. There's a number of dealers out there who wish to contribute prices, who want to share that burden. And indeed, there are a number of buy-side accounts out there who would love the opportunity to participate in an auction, especially, as Matthias had mentioned very early on, that there should be some discount given in an auction process. We don't think there should be any discount given in an auction process. We think there should be a best price, and that best price is assuredly optimized when you have 400 bidders in a room and not just 6.
I think it's very important to go back to that point, though. We're not talking about asking other people to come in, and that is a problem. We clearly, when we have an auction, the more people come in, the better. That's fine. What we're talking about is who is actually contractually obligated to participate in the auction. That is what the issue is here. Who is contractually obligated to price the stuff on a daily basis and participate in an auction. The problem we have in the situation such as Lehman defaulting is not that we have too many people actually participating in an auction, we have too few. That's the issue we have. So if you want to come in and participate, everybody's welcome. If you come in with the same rights, as I said, and the same responsibilities, but you have to contractually be having the same obligations. So there's no issue after that. But to say that somehow if you cannot provide those services, that you might outsource them to someone else and they might be on the hook or might not be on the hook, is a very uncertain situation that makes us very uncomfortable.
That whole issue you just talked about is going to be the subject. I hope will be a subject of another discussion, but unfortunately, because it is a very important discussion as to the structure of clearinghouses, and I'm not committing ourselves to another roundtable, but I would like to have this other session. But with that, we have to end. I really would like to thank each and every one of you for your contributions. I think it helped us a lot. I know it was, you took a lot of time off your busy schedules, and we appreciate it very much. Before I end, I would like to remind everybody, and I don't know whether this is being webcast, but in the Federal Register release, we did invite comment, and there are specific mailboxes that you can send us your comments. And also, when we do come out with our respective agencies come out with our rulemakings, we hope that you will comment. But thank you very much, and we'll adjourn for now. And 1 o'clock is the next roundtable. So thank you.